commentary for the ICT Mentorship. This is the weekly chart of the dollar index. Clean it up a little bit. There's that little fair value gap we were talking about. High, low, higher high. So we are inside a breaker. So we'll see if it wants to show willingness to go lower. All right, on the daily chart, you can see we ran one more time up into that fair value gap on the weekly chart after closing in this imbalance. I mentioned this one here. So now with it returning back like this a second time, if we go back down to this one, it should not act as support and rally. I think if it goes back down here, it's going to go into these highs. Whereas if it didn't go up here like it did today, and it dropped down into that, that would be another opportunity for something like this, you know, to run back for the rejection block, the high sell close, or run the high again for SMT, then move lower. But because we had this run immediately right back to that premium array, that doesn't excite me for dropping down into it to go back higher, because we're going back and forth inside this range between this candle's low and these highs. So this range is being worked a lot. So if it goes down here, it's kind of like a balanced price range. It's going to act very stiff in terms of resistance at that 95.50 level. So I wouldn't like a decline down to this as an order block to buy and expect to go long. If it drops down there, that should give way and then go back to these highs here. So, like I said, I'm not trying to pick the top on dollar, but with Friday's price action as it is here, I do not like this as a potential setup for a buy. All right, you can see how nice that was. Running right back up into that random level. My tongue is in cheek when I say that. The idea of it hitting that and then coming off of it rather sharply, I like that. We'll see if it wants to go below here. If it goes below these lows, we have this imbalance in there, and then liquidity here, and an imbalance right down in here. So if we overshoot those old highs, focus right in here, okay? 15-minute time frame dollar index. Again, you can see right after midnight, small little Judas swing, and then rammed it right on up. Ran the rejection block, high sell close, complete closure of that fair value gap on the weekly chart, and then sharp decline off of that. All right, euro dollar, the weekly chart here. We've been looking for this area down here, this imbalance. It's been on our charts for a week or so now. And the draw on liquidity, I mentioned that would be likely where we're going to. We got real close to it today, but we're off the lows. So if we get continuation on the upside on the dollar, this will be an easy run right into that for next week. Daily chart, euro dollar. Again, you can see we had the little retracement back up in on Thursday's trading. I mentioned that that would probably be the case, but once it got back up into this level here, the algorithm aggressive repricing after hitting the dollar index weekly fair value gap. Just one more time running through. If you look at what the dollar index, I'm not going to go back to that chart, but if you look at the daily chart for dollar, its highs don't match up with these lower lows on euro. So note that for your SMT. All right, hourly chart on euro dollar. You know this imbalance here has been on our charts. All I did was extend the lines out in time. Hits the discount low, sells off. Short-term low taken out, smashes right on through that, and then back above the rejection block there. So we'll see if the dollar index needs to drop lower. If it does, buy side here and the imbalance there and old low. That'll be your focus for the buy side for euro dollar. Euro dollar 15-minute time frame. Sharp correction off that low after taking out that low right there. Just really heavy overnight, just dropping like an anvil. Relative equal lows, they smash down through that, back above it. So before I get into this without saying more, I should have opened up the video with this. Next Thursday is the Thanksgiving holiday in the United States, and you got to treat that week like a non-farm payroll. Okay, I don't personally want to engage in a week like that, but if you are, you're going to practice and such, treat it like a non-farm payroll week. So you're going to be looking for your setups to practice and study in on Monday, Tuesday, and Wednesday by New York. After New York session on Wednesday, nothing. Don't enter. Just because Thanksgiving's on Thursday doesn't mean go right back in looking to trade on Friday. There's going to be a lot of money on the sidelines that just simply won't be available for the purpose of providing smooth liquidity. So, what am I saying? Don't trade on Thursday and Friday. Okay, take my advice, please. Just relax. Enjoy the weekend. I will be doing the Wednesday midweek review as the weekend commentary. There will not be a Friday or weekend commentary. So however the market closes for Wednesday, when I sit down Wednesday afternoon, when I do that, that's going to count as the weekend commentary, because I'm not interested in the price action on Thursday for Thanksgiving. I'm not interested in the price action on Friday after Thanksgiving, and then Saturday and Sunday is the normal weekend. And then we'll resume back on the following Monday with commentary and such. All right, British Pound, daily chart. Bearish order block, I mentioned that. Had some selling there, went down into the order block as well. So it's kind of like held in between a premium and discount array here. So, it's hard to read on cable, to be honest with you. The fair value gap I took your attention to, one more time, ran up into that there, and then smoked all the sell side below here. And I looked at this briefly, and I was expecting this thing to come below here, where I said the sell side would be likely to be tagged if we get a sell off from that fair value gap. We had one more return to it here. It looked like it was going for it, but it stopped dead in its tracks and went back into consolidation. So we're inside of a mitigation block here, and essentially the consequent encroachment of the sell side of balance by some inefficiency here. I don't know if it wants to go for this. If I was a gambling man, which I'm not, but a gun to my head, I would think that they're going to send this thing lower to take that out. It's just too clean. More so than the highs, because we already had 1, 2, 3, and look at the high here taking out these. So they had a stop running event here. Where's the buy side? Taken. Where's the sell side? Here, and a larger pool of it over here. So to me, it makes sense that this would sell off, and there you go. And the 15-minute time frame, again, you can see midnight rallied it right up into that fair value gap. Institutional order flow entry drill there. And that was a real nice decline. That's a quick penny move. That's nice. Not from the institutional order flow entry drill, but from the highs. That's a full penny move, or 100 pips. Trading right down into mean threshold of the last down close candle. Very nice. And then inching back higher, cleaning up all this imbalance, and inside of the mitigation block there. If you extend this imbalance here from the hourly chart, over here we're back inside of that again. So there's a couple things for premium array purposes that might suggest that this could come down here, take out that low, and then run that over here. All right, and finally the NASDAQ, or US 100. And we had a continuation on the upside again, preaching constantly that we're not looking for the top of the marketplace. We're not trying to call the top. And here's the hourly chart completing, in my opinion, its market maker buy model. Again, the consolidation that I was referring to. Distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation, multiple levels of reaccumulation on the upside until we get through here and digging deep for that liquidity. But now here's a caveat. When we are in a bearish market, okay, has this market been bearish? No, it's been bullish. I'm going to draw a contrast for you for your lessons today. if you're looking at market structure and you're incorporating my market maker buy and market maker sell models, let's assume for a moment that this market was a bearish market, but we had the structure here suggesting that we are in a market maker buy model. Once it clears the original consolidation where we had the sideways price action and then it starts to go down just to go to a level where it creates a swing trade higher from there and work its way back up above here. If this market was a bearish market, if it was bearish, I would not expect this much of a run above it. It would be just get above a little bit and then start to move lower. But this is a strong market. It's bullish. So when you see these consolidations, we don't look for it to go up above it shallowly like that and call it a day and that's it. No. When it runs even more above that, all it does is suggest that we're going to see a much more pronounced bull trend going higher. And while this was the original draw on liquidity, this doesn't top the market. And what's the protocol? What was the routine that I taught you? Well, we have an imbalance down here. All right, we're here on the 15-minute time frame. And here is your 7 o'clock in the morning. Remember, what was the routine I gave you last night? If you're bullish, we have been bullish, you draw a vertical line at 7 o'clock in the morning. Here it is. You're bullish, you want to see a Judas swing, something where the price drops down after 7 a.m. It drops down into consequent encroachment of the imbalance in here. And we'll go into a 5-minute chart and we'll see that order block that hits. Here's that imbalance in here. Order block there. Right on the opening, draw that out in time. We're not considering this here because it's not 7 o'clock in the morning yet. Wait for this drop there. It drops inside the order block there, mean threshold, and inside the imbalance for consequent encroachment, rallies. Order block again, opens, trades down to it here, buy it, rallies up, comes back down again. If you missed this one, you buy it again. Why? It's bullish. Even though we had a buy side liquidity run here, this thing is screaming. So you want to probe every potential long idea to get liquidity on the buy side because it's going to keep trying to reach for that, Like these highs here were pierced here. Went back down again, offered another buy there. Where's it going to go to? Well, it's bullish, right? So in an ideal market condition where smart money is buying, where do they look to offset their longs? Above old highs or buy side liquidity resides. That would be above now this high. Boop. Multiple times. So looking at it in here, being Friday, it's not unheard of for it to now on the other side of New York lunch. See, maybe come back down in here and upset some of this because this is, in my opinion, a little too sloppy. They can come down and rebalance this again and maybe clean up some of that. And it still would not unravel the bullish market structure that's in place for this particular market. And again, I think we still have December and all of that holiday hustle and bustle. People are still, going to spend money on their children. They're still spending money on their spouse. They're going to spend money on themselves. So that spending is going to, obviously manifest itself inside of these equities prices. So the share prices should see a continuation going into Christmas. So again, I'm not trying to pick a top, but in here, this looks a little suspect. We had 2 stages of buy side taken out here, and then here during lunch hour, it broke down, small little imbalance there. It works up into that, and it just looks promising for a run below here, and maybe even getting over here. And again, that would not upset. We're only talking about 100 handles here, which is nothing for the NASDAQ. Lately, it's like nothing. So to me, if I was booking this market here and driving it where I wanted it to go, I'd clean up all this and this over here. But I don't make the market for this, so there you go. And again, this is a 5-minute chart, so just don't read too much into that. But I just showed you again what I've taught you in response to questions about, what's my routine? What would I do if I was looking at indices? It's just a very simple model. I mean, it's not a lot of moving parts. Are you bullish or are you bearish? Okay? And do you have a target or a draw on liquidity where it should be reaching for? Well, in this market, you just keep selecting the previous high because it's going to keep running that. Okay, whether it be the previous daily high or the previous swing high on the daily chart, buy side's resting above that. So you keep looking for it to draw to that. There's no science to it once we go into all-time highs. Nobody has a system that's going to be flawless. I don't have one. So you just keep reaching for buy side. So to answer another question I got from one of the ladies in a mentorship, how do I find targets when we're in areas like this, where we've never been here before? Well, you're in Star Trek territory. Okay, you have no idea what you're going to find and how far you're going to go. So you just keep reaching for the stars. Okay, you just keep going higher and higher and higher until the market proves it's going to fail. Now, the concern you may have hearing that is, but what happens if it crashes and you get hurt and you get stopped out? Well, that's what your stop loss is for, and good money management. You're going to have a losing trade, and you're going to have a really bad losing trade eventually. If you keep doing this long enough, you're going to have a bad event happen. But that bad event should not end your career. Okay, it shouldn't impede upon your ability to follow your model. But using what I've taught you this week, it's very simple. You're bullish or you're bearish. You put a vertical line in your 7 o'clock in the morning New York time. Bullish, you wait for the jitter swing to drop down post 7 a.m. Look for a discount array, and everything else is typical. Bullish order block, fair value gaps, optimal trade entries, and you run for liquidity. Isn't that simple, folks? I mean, it's easy, right? I mean, obviously I make it look easy on doing this, but isn't this exactly what I outlined this week? I'm not bringing in commitment of traders. I'm not requiring you to look at bonds to support this and support that. It's very simple. You can make your model as simple as this, or you can make it as intricate as possible. If you like to be like that, if you want to be, aerospace level engineer analysis, go ahead, do it. Go for it. That floats your boat. But don't think that you have to have all of my gadgets. Like I said last night, there's no reason for you to apply everything. If you know what you're looking for and you use the right tools at the right time, not trying to make a hammer be a screwdriver, you have everything you need. You're reading naked price action, even though I have lines here. I'm using it to annotate the idea, where I won't look at my charts with these lines. I like to have it clean. Because if I have my chart clean, and this is what you would like to graduate to over time. Not yet, not even the 2016 group should be doing what I'm about to say. But eventually, you don't want to have any lines on your chart. And the reason why is you don't want to marry these ideas, because even though you have these annotations on the chart like I have here, and they're pretty, they illustrate the narrative that I'm trying to illustrate to you in my teaching, and it helps you see what I'm communicating. We're bullish, we're looking for specific things. By annotating your chart like this while you're learning, it helps ingrain these ideas theoretically and conceptually in your subconscious. Once you understand them really well, you don't need any lines on your charts. You want them completely clean. And the reason why I rely on a naked chart is because I want to see something obvious. If something changes in the underlying pinnings of the marketplace, if there's a disturbance in some kind of a bullish scenario, if I have these levels on the chart, I'm going to be watching how they react and respect those levels, and I may miss. And you watched me do this week where I had a complete oversight of the dollar index small little fair value gap. When I took you to the weekly chart, it completely went right over my head, didn't even notice it. But you can see the effects of it once, obviously, it got there, and then we've seen it tag it again. So, you're going to mess up and not see something in the chart. You're human. You're going to be distracted by something, or you're just not going to notice it, or read it wrong. That's all possible. But I like to keep my charts naked because I will be more sensitive to something forming that may give me an indication that, okay, everything I was expecting in the marketplace was true up until now. And if I have these lines on my chart, now I know by saying this, you're going to think, well, then I'm going to try to understand this better without having it on my chart, and you're going to stunt your growth. Okay, I'm not telling you this so that way you can say, well, I'm going to get to ICT vision without having the lines on my chart, and then I can say I can see it like him. Once you understand the concepts and you know them very well, then start to work with less on your chart over time. Because you can see these imbalances over here. You don't need to have that marked up. You know, you don't need to see a line on this order block. You can see it. Your eye goes right to it. It will if it's been a lot of back testing and studying and journaling. But if you don't do those things like I was talking about last night, I'm not going to make this a very long video. Trust me, I'm not going to do it. The idea of having it understood and having it ingrained in your subconscious, you won't need to dress your charts up because you'll see it. Your eye will just go right to the things that matter most. You'll know where the discount levels are, the premium levels are. You know what your bias is based on looking at the higher time frame charts and where the draw and liquidity is, and you know what the time of the day is. I don't need to have any of the kill zones annotated. I'm just teaching, over here I'm teaching you the New York lunch hour where it usually creates the significant higher low in the day. And you want to be getting out as you get closer to that. And during lunch hour, notice it just goes a little bit above that, not by much. If you got out here, I'm not suggesting I did anything today because I didn't. But if you would have went long in here and covered that long here, would you be upset if it just went above it a little bit more? You shouldn't, but you have to know how to divide the day on these indices and work within the morning trend. And then if you want to do trading in the afternoon, post New York lunch at 1 o'clock to 4 o'clock, then I would use less leverage. Even though the moves can be faster and shorter in duration, whatever you see in the morning session, it can hurt you too. So it's just, in my mind, if we were going to be reducing it down to, if you could only do this type of trading when it comes to indices, I would literally only do the morning session on indices, because the opening on the equity market is just a real nice volatile session, and it creates Judas swings. And if you know what you're looking for from a higher time frame, you're bullish, you look for a Judas swing after 7 a.m. down to a discount array, and then off the races. Start reaching for a buy side. And if you get it, pay yourself. If you make money in the morning, do not go back in after lunch. It's simple. There's some simple rules, man. Very, very simple. But it's real hard to adhere to it, because when you trade these kind of markets and you get dialed in and you find them and these setups start paying out, you're like, oh man, I want to go in again because it feels amazing. It feels good. You feel right. And feeling right is not equivalent to consistently long-term profitable. You got to have one or the other. And to be long-term consistently profitable means you're not always right. And that sounds like an oxymoron, but it is exactly what you'll find is the truth. All right, with that, folks, I'm going to wish you a very pleasant weekend, and I will touch base with you on Monday. Be safe.